Hey, how's it going, everybody? Get some updates on my passive income portfolio. In the last few months, I've been doing some buying and a little bit of selling too, just trying to kind of moving the money around with the companies in the portfolio. Obviously buying some bonds here and there, as well as continually adding into the high yield savings account. It's kind of hard to pass up on like essentially free money, but also still buying stocks just because of the, I guess, more longer term perspective or horizon on there. Just a better vehicle, I think, in what history has shown us. Investing in companies as opposed to bonds or cash just allows your money to appreciate more, as long as you're kind of buying actual companies that have the ability to grow. Anyway, I'm gonna digress a little bit. Let's get into the actual portfolio. So this is a snapshot from August 2nd. What I'm going to be doing probably from now on is every month kind of doing something similar to like this and comparing the portfolio to the previous month, kind of things I added and things I sold and stuff like that. I also like logging things more in a book. I mean, I obviously have Excel sheets and stuff, but I think notebooks and stuff like that are kind of just, I think are becoming like a lost art. And yeah, I appreciate the handwritten stuff. So anyway, that's kind of how I'm going to be doing it and structuring some of these videos, depending on if people enjoy it. Sitting at about 18.2% of the portfolio. Got Snap-on. Really like this company. I mean, if you've been following this channel for a while, I've been talking about it for probably like 2 years. Maybe not 2 years. Actually, probably. Wow, time goes by fast. Snap-on though, excellent balance sheet, generating a lot of free cash flow. They've been averaging, I think it was like, I have it somewhere in here. Trying to consolidate all my notes and stuff into like a single book, but that's what this book is going to become. Yeah, they've been growing their dividend 13% over the last like 4-5 years. So it's not to say they're going to continue growing at that rapid rate, but yeah, just that's what they've been doing, and they have the cash flow and the growth to support that as well without raising their payout ratio too high. At least that's from the numbers I've been looking at. And again, numbers are a historical thing, and they're like snapshots in periods of times, or a snapshot in a period of time, but at the same time it can somewhat help not predict the future, I don't want to say that, but it can help give an idea of how the company is behaving and might continually behave. Anyway, I got 20 shares at about $266, so I'm definitely not low here, like pretty high. This company was like less than $200, I think, maybe a year and a half, 2 years ago. Don't quote me on that. I don't have the charts up, but definitely got more expensive. The yield right now on that's 2.8%. I was buying it back when it was like 3%, maybe even higher, maybe like 3.2, and I just continually bought up. Not necessarily happy with the price I'm buying it at, but from the numbers and stuff I'm looking at, it's just a good company on paper. So that's why I don't mind necessarily buying it a little bit higher. But again, I do understand that there is some risk associated with buying it at that higher price. As of August 2nd, the position is about 4% up. And yeah, I'm just going to continue to add. Probably going to add another share or two this month. Not necessarily, I'm not too picky. Again, I haven't been too picky with the price, kind of just buying it every month or so. But yeah, Snap-on, love the company. I think 18% is getting a little, 18% is getting a little high relative to the portfolio, but at the same time, compared to all the stuff I'm looking at, like, I just like the company. So anyway, going to Exxon. I got 40 shares, about like $40, about 9.6% yield, up about 195%. It's about 15% of the portfolio. Haven't bought in this since COVID, so it's been like 4 years since then. I kind of wish I did a lot more buying, but yeah. Anyway, they raised their dividend maybe 2 quarters ago. I haven't really been making any videos discussing anything. So this percentage increased recently. If this goes to like $100, I actually I'm debating picking up like a share or two. I do want to run some more numbers and you can read their balance sheet or whatever. Not read their balance sheet, read their like quarterly statement. Actually, December is when they're gonna have their end of the year earnings. Same thing with Snap-on. So those are always kind of worth reading. Like the quarterly statements and stuff, I feel like, yeah, they're good to look at, but the yearly is, I think, a better data point. just to compare to previous years. But I don't want to say I'm looking at all these companies super intensely. I know everything that's going on with them, but from what I've at least noticed briefly looking at with Exxon the last year, 2 years is, I mean, oil and gas, as much as like the renewable energy people think, not say people, but the companies and stuff with renewable energy, yeah, I think renewable energy is important, but it's not gonna overtake like things like oil and gas anywhere in the very near future. You still need oil and gas to function as a society, and Exxon's doing some good plays capitalizing on that, but also they are doing some sort of renewable practices, or at least trying to limit the carbon emissions and stuff, whatever. Anyway, I need to do more due diligence on that and where that's heading, but I got a pretty stable position actually. Yeah, it's been almost 5 years, so with a yield of almost 10%, just doing quick math, like I'm like almost, let's say 40% of my money I've gotten back in just dividends. And I mean, again, it's not that massive of a position, but relative to my portfolio, it is. So anyway, I'm not going to really necessarily do anything with Exxon. Definitely not going to sell it. If it goes lower, probably add a little bit, but I need to read some other reports, see what's going on. It's been a little while. Next up, we got SCHDs, the ETF, the Schwab High Yield Dividend. Got 58 shares, about like $72, $76, sitting about like 3.67% yield. This does fluctuate, obviously, depending on the quarter, what's in the portfolio, and when they rebalance it. Up right now at about 11%, and that's about 15% of the portfolio as well. I would like, so if we actually go down to here, where is it? ETFs are about 16% of the portfolio. We got some VMY down here. I would like that to be probably 20%. So if the opportunity presents itself, I will be buying either more of SCHD or VMY. But looking at the dividend and as well as the assets within the ETFs, SCHD just seems to be a little bit better of a ETF. And again, it's going to be dependent on, you know, kind of what you want. But at the end of the day, the goal is quite similar. I just think SCHD aligns more with what I want. So again, they focus on higher yielding dividends with companies that like could sustain the cash flow. VMY, actually, I'm going to be honest, I didn't actually read their prospectus, or at least that section of the prospectus, but I know it's somewhat similar to SCHD. I don't know the details, but yeah, gonna probably pick up some here and there. I've been buying that basically every month for the last maybe year or so. I used to be pretty anti-ETF because I didn't understand it. I didn't understand how the dividends work. I didn't understand how they rebalanced, and I mean, I could just did some more research and stuff, but I didn't. So anyway, picking up the shares now, and now that I understand them to at least a greater degree. Intel, this is very sad. Got about 130 shares at about almost $42. The yield right now is like 1.19. They did cut it, I think like a year ago now, a year and a half. They cut it like in half, down almost 50%, and it's about 9% of the portfolio. One point of the last few months, I was up 12%, and I was debating trimming the position, but I thought it was going to keep running up a little bit, or at least pull back, and then, you know, kind of level off, then go up. But it kind of just shot straight down since then. Yeah, this is a lot of learning in this position. I haven't sold or bought any more shares since the low of like when it was like $25. Now it's at like, it was at 19 as of this morning, so not the best feeling. Actually, was it 19? Maybe. That'd be more than 20. So yeah, sorry. This was August. There's August 2nd. According to the video, August 7th. I didn't see what the price was today. It doesn't necessarily really matter. It's not going to change too much of my opinion on the stock, but it just, yeah, I want to definitely dedicate like a whole video to this. Just it is very heartbreaking in a sense when you owning a stock in a sector that's exploding and all the companies around it are going up, and I got my money cut in half basically. Haven't sold it yet, so obviously I didn't lose that money, but it's unrealized loss of a lot. like Nvidia, AMD, even Qualcomm, Apple, Microsoft, all these other tech stocks, even like the semiconductors, man, they're up like 100 something percent since the time that Intel, like I was buying Intel. So it's again, a lot of learning in this, or a lot of lessons learned, I guess. But it's tough. It's tough. Moving on, J&J. This is actually recently a new position. Got 14 shares at about $150. Yields about 3.3%. Looking at about 9.5% gain and about 7.5% of the portfolio. Started buying this maybe a month or two ago, maybe 3. I don't even know at this point. Time is going by quite fast. I like the yield. The company dropped pretty low. I think it got to like 140 almost, maybe 145. But I was picking it up before they got kind of. I just noticed it was getting low. The company's pretty good, and the yield was getting to. I think I hit 3.4% at one point. The one thing I don't like though is. So, that's why I have it here. Again, forgive me. I'm trying to update this as much, or get as many things in this book as I can. But got some like words to live by, or like my strategy in a sense in the beginning. I guess I don't have like specific numbers, but I have all the variables that I consider to be the most significant, and I want companies with like very low leverage. J&J is not one of those companies, at least from my initial assessment. We'll have to dive a little bit deeper, but if you look at some brief metrics, it's not looking too good. So I want to try and stick to. See, it's hard trying to stick to not leveraged companies, but so many companies have leverage, and also like understanding when it's beneficial, like because obviously you want to take on some debt to explore more opportunities and have those chances. I just hate seeing those numbers, and it's hard to justify buying a company that spends a lot of money in debt paying interest, or having to pay a lot each month each year in interest, and they're paying dividends, but they're also taking on like additional debt. It's hard to justify. I need to do more. I mean, I've already been buying it. Obviously, it's already 7% of the portfolio, but I probably should have done a little more due diligence with J&J. So I need to do that as well. It's on my list of things to do. Trying to stick away from the debt companies. So like moving on, another one, Verizon. Verizon, I would like to sell. Got 40 shares, about $51. Yields like 5.25, down to about 20%. It's about 5.5% of the portfolio. Verizon just has, I think, if I remember right, it's like 180 billion in debt. I don't remember the exact number. Don't quote me on that, but I know it's in the 100 billion. So a lot of debt. I get they have like infrastructure and all this other stuff, but if they're only generating like, again, sorry, I don't have all these numbers in front of me, but they're paying so much money each quarter, financing their own debt and paying the dividend, that their any free cash flow that they have either goes to either of those, and they're not able to like invest back into themselves. And it also raises the question, it's like, do they even need to? Like if they already have the infrastructure and stuff, and the answer is probably not. But if you need to pay off your debt, you need to pay off the interest and the actual debt itself. So any debt they refinance, that was at a higher rate just because of the market. So that's another game I just don't really like playing with companies that Verizon I do want to eliminate. I'm hoping to get like an opportunity. It's just like right now not that I don't see a reason. Yeah, why don't I just sell? I'll ponder that. Anyway, Smith & Wesson got like 100 shares at almost $17. It's like 3.10% yield. 6.2% of the sorry, I'm down 6.2%. It's about 5% of the portfolio. Only shares for a while. This is another company with like no debt, like at all, like zero. I think actually this year, it's been like a while since I even noticed anything with this company or looked into the company, but they were moving to, is it Kentucky or Tennessee? From Massachusetts. So that's a huge play, I think, for them. See how that does. But they were down like $8 at one point. That was pretty crazy. and they stock shot all the way back up. I was buying a little bit here and there on the downward move, but also I was buying like $20, so it would have been a lot nicer to pick up the position. I just have a habit of buying stocks that immediately just drop, not immediately, but over like a year just drop, like cut in half. Happened to a couple companies. But Smith & Wesson I do enjoy owning because they're not leveraged at all, and they pay somewhat of a decent dividend. It's just the market that they're in, as well as future growth, is what hurts. So the valuation on this should be more picky in deciding what the company's actually worth, and that's kind of tricky. Like when I was valuing it back at like $20, it looked good, but that's because like the free cash flow the year and the previous year was great, but it's not consistent. Anyway, moving on, we got Simon Property. You got 8 shares at about $116. Yield right now, I got 6.86, up about 30%. It's 4% of the portfolio. They got a good yield, don't get me wrong. They definitely do have a lot of debt as well, but that's because of the sector that they're in with the retail properties. I like that yield nice and fat. I definitely don't want this, because of what happened during COVID, it is always a little spooky, just because this thing has the ability to get, not I'm gonna say cut in half again, but just that the mall space, I'm on and off about it. Like I see the future with it there, but then also I see the market declining because of online stuff, but there's still people that are going to go to the store. You're still going to need to have like these online presence. It just might not be as big of a market in the future, or it could be bigger, I don't know, but they're paying a fat dividend, I think, and I got in at a pretty good time too. I think it's up, it's like 140 maybe now. Just having it in the portfolio under 5% I think is okay, but yeah, I haven't added or anything with this. I haven't added Verizon, Smith & Wesson, Simon Property. We got Ruger RGR2. I haven't added in a while. Got 19 shares at about $55 almost, about 1.95%. This does fluctuate. They keep this at 40% of their any net income that they earn, down about 21%. It's about 2.7% of the portfolio. I think owning Smith & Wesson and Ruger in the same portfolio is redundant maybe, and not needed. So kind of looking for an opening to get out of either one of them. And I mean, there's nothing earth-shattering or any reason that I've felt the need to sell now. So that's kind of why I'm getting at, or what do you call it? I have them both. I was positive in Smith & Wesson within the last 2 months. It did go up to I think about like $18. Debated selling it actually, but obviously I did not. Just there's a lot of short interest in Smith & Wesson. I think there's some in Ruger too, but definitely more Smith & Wesson. And you get that earnings, you get that good earnings, you get that pop up, like just the short's got to cover, and that just rides up. That did happen. I don't know if anyone is going to remember or follows it that closely, but I think 2020 or 2021 during COVID, Smith & Wesson did go all the way up to $40. Like that was insane. And that was, I mean, a lot because of good earnings, but also there's a lot of people shorting and they really had to cover. So that's why it exploded. So, I mean, I got it because I think it's a solid company, but I think what I'm really hoping for is sometime in the near future, it just explodes up based off of good earnings or something. I mean, maybe I'm just hoping for it. But again, I like the company in itself. I just got in at a pretty bad price because I guess it's relative. That's you're not gonna know if you get in a good or bad price until you get in. But anyway, UPS. This is a relatively new position. You got 3 shares at about $136, about a 4.78% yield, down about 6%. It's about 1.3% of the portfolio. I am adding a little bit here and there. They've been, I think they felt like 30-something% the last like month or so, maybe a month or two. They also cut their earnings forecast or earnings outlook too, so that is impacting the stock. I do want to, I have a pretty small percentage of the portfolio because I do want to do a little bit more like diving into the fundamentals. And I know technically you're supposed to look at these numbers and all this stuff before, but sometimes an opportunity presents itself and you're like, hey, that stock kind of dropped. I want to pick up some shares and then I'll dive a little bit deeper in the future. So taking on that additional risk to get a potentially a better price entry. But the yield's great, almost 5%. It's just, can they sustain it, and how much money are they going to be making in the future? Will they have to cut it? I don't think UPS has ever cut their dividend, but it's not to say that they won't, because the companies obviously have done that, and I own them, or have owned them in the past. So yeah, probably going to add maybe another share this month. We'll see. Not like a top priority, just because, again, I don't have the full understanding of their balance sheet, as well as have an idea of what they're going to be doing in the future. BMY, this is Bristol Myers. Got 4 shares at $48, roughly almost 5% yield, up 0.1%. Again, all this is August 2nd, as of August 2nd, and about 0.6% of the portfolio. This dropped, I think this went all the way down like $40. I'm not gonna say that this is like a trade, but again, the stock dropped. They're getting hurt a lot. I kind of saw it as, okay, well, the stock keeps dropping a lot, so maybe I'll pick up some shares. Again, literally some shares. Throw some money at it and see if we get a decent price point, or maybe get a little pop here and there. But yeah, it's also nice to see these high percentage numbers in the dividend. Not the best reason to own a stock, but Bristol Myers is a pretty good company. Or, okay, I should probably emphasize what I mean by good company. Company that has been around. They have their footprint in places. Well, be honest, I did not do my due diligence on this either. That is why it's also a very small percentage of the portfolio. If I lose all the shares right now, this company goes bankrupt, I ain't gonna be that sad. Hasbro, got 2 shares, about $47, almost 6% yield. I'm up 35%, and about 0.4% of the portfolio. Again, same thing. Like, stock dropped a lot. Over, I don't even know when I bought it, but whenever it was like that price, I think it's, yeah, whatever, it's like $60-$70. Sure, probably $65 now. I didn't throw a lot of money at it, but I threw some money and said, hey, stock dropped. It's a company that sells games. It's cool. Definitely not the best balance sheet I've seen. Actually, it's atrocious, if I remember correctly, but the stock dropped a lot. They're still paying a dividend. Can they recover? Cool, maybe they did. And I'm actually probably debating selling this. It's like, yeah, you own 2 shares at that amount of money. You get that yield. Like, what are you making, like $10 off of that? Maybe. Actually, I got the Excel sheet up. Let's see. Give me 2 seconds. Making $5.60 a year off those 2 shares. I could sell right now and I could make like $30. So I don't know. Just again, not like massive amounts of money over here, but just a normal dude, not a millionaire or anything. Just threw some money at it. Thought it'd be kind of cool. Went up. Now I just gotta decide, do I want to sell or just hang in there and see what happens. Next up, we got Merck & Co. Why do I always forget how to pronounce this? Anyway, I got 3 shares, about $120, 2.56% yield, down about 4%, 1.1% of the portfolio. New position, recently added this. They fell a little bit off of earnings. Actually, I think they fell like 10%, right? Anyway, they fell. Started picking up some shares, and I guess now I'm looking at it, they're down even more. I'm down 6.6% today compared to 4.4. Not the best, but just another good position, good company. Their balance sheet also, I think, is pretty rough, but same thing with like J&J. They're in the healthcare sector, or I guess pharmaceutical, kind of same thing. Definitely need to do a little more due diligence on that as well. But again, small position, just want to buy some shares. Then we got VMY ETF. So again, one thing you could probably notice is there's like the companies that are above like 10%, I kind of know a decent amount about. You get these middle companies where it's middle percent of the portfolio, and it's just like I know a lot of, or not a lot, I know enough about them where I feel comfortable, but definitely need to do some more learning. Then I own some of these shares or companies where it's like I really need to learn more before I add any more shares. But at the same time, it's like, it's a starting point. Getting your feet wet, dipping your toes in. Anyway, just kind of recapping that, but we got some cash too, about 13% of the portfolio, and I will be adding some more money this month. Not like dying to add. So again, this cash is cash that's only within the stock account. I'm not including any bonds or high yield savings. So if you add up all this stuff, work out some numbers, we're looking at about 3.45% portfolio yield. So pretty cool, but again, bonds right now are about 3. Quarterly bonds right now are about like 5.1%, maybe 5.2, and high yield savings are about 4.2. So definitely worse yield, but also it's more risk, but also potentially more return because you are getting the appreciation. You get bonds and high yield savings, you're not at all. So this should probably be lower just innately with the risk, or I guess your risk reward. Total portfolio gain though, compared to all the money that I put in as of August 2nd, it's about 22% gain. So I mean, not incredible, but definitely good, not negative. And again, I'm consistently adding money, so if I add some more money right now, I mean, it's the portfolio gain technically goes down, but it's not a metric that I'm judging my performance necessarily on, but it's kind of nice to look at every now and then. I guess, yeah, that is a good question though. How do you judge the performance or the success of the portfolio? I think it's hard to tell, I think owning just quality stocks that I feel like that should be an easy question because the answer is this, but it's not, because I got like 30-40 years left of my life to own companies, so maybe ponder that a little bit. Anyway, cash, we got about 13%. Dividend stocks takes up about 71%. 16% are ETFs, and I'm not trading anything right now. Technically not trading anything, but at any moment I can sell something, and with the intent, all these things, again, I'm buying for not a trade, I guess. Like a trade is probably under a year, or like you're intending to buy something with the intent of selling like in a relatively quick time manner. And quick, again, could be like 6 months. But nothing here I bought I'm intending on selling immediately. So some things recently I did, sold 3M, sold Walgreens. Big losses in both. It's actually sold like half the position of 3M maybe like almost maybe not a year ago, but 6-7 months ago. Recently sold the rest, and I was only down like 10%, but from the initial position it was like at $150. So I think I sold at like 120, then 110. Either way, big losses. They cut their dividend. They did some stuff that I didn't like. They have a lot of debt. The writing was in the wall, and I ignored it. And I remember even watching a video. I remember watching a video about someone discussing their debt and how they're just not going to be able to like finance it, and the growth of their company, which just wasn't matching like not the market, but just the economy or the world around them. And I don't know. I should have made better decisions there. I still don't think it's like necessarily a bad company, but again, buying a company, buying the stock is a little bit different. Either way, a lot of debt. Walgreens, I was buying at like $40, and they cut their dividend too, and they're just a hot mess. I wanted out. And before they dropped on earnings, I think to like $10, I did sell. I think I sold like $16. But yeah, man, they're down to 10.78 as of today. It's crazy. Their yield is 9.9%, and their yield was like 9% too when it was back at like $25. Just not good. Not good. They had a lot of debt too, and they're not making any money anyway. So I got planned to move away from companies with a lot of debt, even though I just bought Merck and J&J. So it's just so hard to find. I just think it's so hard to find good companies that have little debt, that are paying a dividend that's above like 1%. Like I'm honestly, I'm not going to buy a company that's paying a dividend of less than 1%. To me, that makes absolutely no sense, because at that point, just either buy the ETF or you just, I think the risk reward starts getting really low there. And I get the companies increase dividends and stuff, but I don't know. It just to me doesn't make too much sense. So I got BMY, Hasbro, Smith & Wesson, Ruger on the watch to sell. Again, I'm not necessarily trading them, but they aren't out of the question of things that I wouldn't sell if opportunity presented themselves. But yeah, anyway, that's kind of the portfolio as of August 2nd. So next month, or I'm going to be making some notes here and there about things that I'm adding and stuff. And the next month we'll kind of go over the same thing as well and see what the portfolio is doing. See what some stuff we added. No reason to make like a bunch of videos though. I mean, this is longer term horizon stuff, and not too many things are going to fluctuate. I'm going to try and develop this book a little bit more. Like I have Excel sheets and stuff, but I don't know. I miss the art of paper and pen. It's nice, you know. It's nice. Anyway, that's all I got for now. A little bit different, if you've noticed, a little bit different style video than on the channel, but let me know what you think. If you enjoyed those, stick around for the next episode. If not, well, let me know anyway. Take care.